Hi guys, and welcome to this VCE Year 12 economic video, which is going to cover Unit 4 Outcome 1 content. We are focusing on monetary policy here, and we're going to try and get an understanding in this video what we mean by an expansionary monetary policy and contractionary monetary policy. Now, if you look at our key knowledge for monetary policy, you can see that it is our fourth key knowledge point. So there is definitely some assumed knowledge here around what is monetary policy, how the RBA influences interest rates, the transmission mechanism of how interest rates impact economic activity, etc., and inflation. So you might want to have a look at those previous videos if you've just discovered this one. But as I said, hopefully a pretty short video that explains what we mean by expansionary and what we mean by contractionary in monetary policy. Now, what is meant by these monetary policy stances? There is really three approaches or three stances that the RBA may take in regards to monetary policy. They might take a monetary policy that is neutral, so they might adopt neutrality. They might adopt a policy that is expansionary, or they might adopt a policy that is contractionary. So we're going to focus mainly on expansionary and contractionary monetary policy, but we will expand what we mean by neutrality as well. Now, before we go into this, as a quick revision, let's understand what the RBA is doing. The RBA is controlling interest rates. They are controlling interest rates to influence inflation. And they're influencing inflation because no inflation is going to be a driver of economic activity, confidence, living standards. So the RBA, if they make a decision to increase interest rates, they know that this will decrease aggregate demand, decrease economic activity, and hopefully decrease inflation by reducing spending, because there'll be less ability to spend if you're paying more money for your debt. Now, if they decide to lower interest rates, this will increase aggregate demand, increase economic activity. This will happen because there has been stimulated spending. There will be more spending because there's lower interest rates, but this could create some inflationary expectations. So why do they increase interest rates? They do this if inflation is above the target of 3%, because the RBA's target is 2 to 3%. And they will lower interest rates if they feel that they want to drive some economic activity and they're not worried about inflation because it's below their target of 2 to 3%. So let's talk about what actually is an expansionary and what is a contractionary monetary policy. Now, here you're welcome to have a read. I've explained what a neutral monetary policy stance is, and this is where they have set a rate where they don't really want to stimulate, so make the economy bigger, or contract the economy. And that typically means the cash rate is around 3%, although that's not a hard and fast rule. What we're going to focus on is what is an expansionary and what is a contractionary monetary policy stance. Now, the first one we're going to think about is expansionary monetary policy stance. Now, I always think about what does expansionary sound like? It sounds like the word expand. And if something is going to expand, it's going to get bigger. So logically, an expansionary monetary policy stance is a stance that the RBA is taking where they want to drive growth and make the economy bigger. So an expansionary monetary policy stance is where the setting of the target cash rate is low, and it is low enough to expand the economy. It is low enough to be stimulating aggregate demand, and this will increase inflation, but they're okay with this because they want to grow the economy. This means it is likely that inflation is less than 2%. Because it's below their target, so they don't mind it going up a little bit. They want the economy to expand. They want to stimulate aggregate demand and GDP. This is typically by setting a cash rate of below 3%. And this is typically employed by the RBA when the economy is growing below trend. They want to expand it. They want it to get bigger. Inflation is low, so they're not worried about inflation, as I mentioned, and employment is relatively high. And I should probably write that. I've probably made a mistake. Unemployment is relatively high. And they want more people to have jobs. This stance is used to stimulate economic growth and allow inflation to increase to the target range. So they're wanting to get inflation back up to that 2 to 3%. Now, contractionary monetary policy is different. If you think about the main word here, that's going to I'm hoping you're going to pick up. We are talking about contract. And if something contracts, it's getting smaller. So a contractionary monetary policy is where the RBA is trying to influence the economy to make it smaller for a reason. And that reason is inflation is getting too high. So a contractionary monetary policy stance is one where the setting of the cash rate is high. They have set a higher cash rate and it is high enough to restrict aggregate demand and decrease inflation. This is because inflation is most likely above the 3% target. They're a bit worried about inflation and they're wanting to control that. And the only way they can do that is to contract the economy, take demand out of it. This is typically a cash rate that's above 3%, and it's employed by the RBA when the economy is growing above trend. Most importantly, inflation is high. That is why they are doing it. And unemployment is relatively low. So they're wanting to take the heat out of the economy. This stance is used to restrict economic growth and allows the inflation to hopefully decrease to the target range of 2 to 3%. Now, if we think about in July 2022, when I'm making this video, we know that our last inflation figures were 5.1%, and that's why interest rates are rising, because the RBA is worried about that inflation number. They think it is going to go higher, maybe even to 7%. So they're trying to take the heat out of the economy, and they are rising interest rates really, really quickly. So to summarize, and you can use this YouTube video if you will like, and I'll put that in the links. If there is a tightening stance, and tightening means a different term, but we are going to be contractionary monetary policy, this is where the cash rate goes up, leading to interest rates going up, mortgage repayments going up, because if interest rates are high, you have to pay more on your mortgage. That means people will have less money left over because they've had to pay more on their debt. That means they have less money to consume, and consumption is your C and maybe even your I part of aggregate demand. This is going to decrease our economic activity. If aggregate demand goes down, this will reduce inflation. Now, the opposite is loosening stance. This is if you have an expansionary monetary policy. This is where the cash rate goes down, leading to a decrease in interest rates. This reduces how much people have to pay on their loans, specifically in this case, our mortgages, so home loans. This means you'll have more money left over, more ability to consume, more ability to spend, increasing C. This will increase economic activity, so increase aggregate demand, and hence inflation will go up. So you're starting to see why they're doing this and how the flow and effect works. And if you're wanting to know a bit more about this, the transmission mechanism video will explain how this actually works in a bit more detail. Now, if you're wanting to try and see what's been happening since 2007, you can see and try and see these potential links. You can see that the green is our target cash rate. And way back in 2007, this is where we had our highest interest rates. This was because we had a very contractionary approach. And you can see this is why. This is because our inflation rate, our red line, was outside of our target of 2 to 3%. So this is not a very well drawn line, but theoretically, and we'll see if this pattern holds true, anytime inflation got above 3%, we're above target, and you can see it occurred here and here. This is when we should be having contractionary monetary policy stance, and interest rates should be increasing. And you can see that this has occurred. These are the two times interest rates have been at their highest. Now, during times of when inflation has been at its lowest, around here, and especially during COVID here, you're starting to see the interest rate or cash rate go down. And you can see that ever since 2010, the cash rate has progressively gone down. And this is because inflation has never got above that 3%. In fact, it's dropped below. So the Reserve Bank has been trying to drive growth. Now, it's a little bit hard to see here, and we're not going to see as much of it. And this is since 2017. What is important to understand is we know now that the cash rate has jumped, and we know that the cash rate has jumped because we have left COVID. We've got past our recession due to COVID, and you can see we had a very expansionary stance here because of really low growth, and in fact, for the first time, negative inflation. We have now gone outside of that. We have now got inflation that has jumped all the way up to 5.1%. And we can see our interest rates have now started to jump again quite dramatically. And they're now at 1.35% with many more increases to come. Now, I hope that this has helped you understand monetary policy, and in particular, expansionary and contractionary. Monetary policy that is expansionary occurs when the cash rate goes down. And this has occurred because we want to drive aggregate demand, increase economic activity, so expand the economy, and we understand that this will increase inflation, but we're okay because it's below our target at the moment. Contractionary is when we're going to increase our cash rate. We understand that this will reduce aggregate demand, reduce economic activity, because we are enforcing people to pay more on their debt. And we are doing this to drive down inflation, which is likely now above 3% above the target. If we are reducing our cash rate, it is likely because inflation is below our 2 to 3% target. I hope you found this useful. I hope that's been a good explanation of expansionary and contractionary monetary policy, and keep studying economics.